Hey everybody, we're back with a market update for September. Well, things have definitely changed out there, and whether you're a bull or a bear or whatever kind of animal you want to be, the real estate market has changed.
Absolutely, it has. And how much it's going to change heading into 2023 is going to be determined here in the next 4 to 6 or 7 weeks. So, let's take a look at the numbers.
Well, I think the theme of today's talk is going to be how interest rates are driving the real estate market right now. Would you say that's accurate?
I would say so. It's definitely not a glut of inventory that's slowing sales or anything like that. Pending sales have remained very steady for several weeks, even a couple of months in a row now. And there's not a ton of new listings coming on the market, and standing inventory has actually been shrinking. So we don't really have what would be considered an official buyer's market at all, just due to lack of inventory. But what's killing buyers and sellers right now are interest rates. And there are ways around that for buyers. So ask us more about that and check out our video yesterday.
Yeah, you had an interview with John Fuller from Cross Country Mortgage yesterday, and he had some really good ideas about how to lower your monthly payment by using different loan programs.
Right, and so that's a whole other discussion. But should we jump into the numbers?
Yes, let's start talking about the numbers. So we're going to look at what's been happening month over month, kind of a zoomed in view, and then we're going to zoom out and talk about year over year trends. So
right.
Let's get into it.
Yeah, because the month over month numbers and the year over year numbers are telling slightly different stories when it comes to what metric you want to look at. But right now, let's look at the month over month. New listings in July, we had 3616, and in August there were roughly 600 less new listings. So that's a 16.1% drop in new listings. And then pending sales, about 2,300 in July and more in August. So that's a 12% increase in pending sales. So that right there is an indicator that, there's buyer demand.
And I want to talk, can I talk about this for a second?
Sure.
Because pending sales, which indicates, buyer demand, how many homes people are buying, that's been relatively steady over the past several months. So buyer demand isn't changing that much, but this increase in pending sales and also the resulting closed sales. So in early August, there was a dip in interest rates, even though the Fed had recently done a 3/4 point bump.
Right.
And that dip in interest rates coincided with an increase in pending sales. So people took advantage, they bought that dip, and that's that 12% increase we're seeing there. And the closed sales happened, 30 days later or so.
Yeah.
So that was, that's what happened there.
Right, and that to me is evidence that, there are buyers out there waiting to pull the trigger. So that's good news for everybody. And yes, there was a dip in rates, but you don't have to wait for a dip in rates. That there are things we can do here that are gonna work for you.
And we might not have another dip in rates. It might keep going up. So this
right.
This could be as low as it's going to be for quite some time.
But as long as there isn't a ton of inventory on the market, you're not going to see this calamitous price drop. We've definitely seen the median price come down and prices get softer and sellers become more negotiable. But you're not going to have a really tremendous drop in price unless there's a huge surge of inventory, which would be completely unprecedented in the later third and fourth quarter of a year.
And we kind of already had a surge in inventory. It was June? We had a lot of new homes come on the market.
That was
So I wouldn't expect another big surge. The people who were looking to sell ahead of this have done it or are trying to currently do it.
Right, still working on it, because unfortunately that surge in summer inventory just landed right on top of that giant rate increase. So anyway, we digress slightly, but we'll keep going. Closed sales in July were 2,126, and then again more closed sales in August, as you point out, due to an increase in pendings. And that's a 16% increase month over month. And then the number of homes for sale, as I mentioned earlier, is declining month over month, down 10.7%. and the median price is down 4.2%.
Took a little dip.
Yeah, 4.2%. And I guess we'll get into the year to date, which is more reflective of where we really are with median price. But month over month, yes, we've seen another decline.
So buyers are still out there and they want to buy, but they're kind of hanging around, kicking the tires. They're not willing to pay as much as they were before.
That's right. Okay, so new listings, we already talked about. Year to date, we're down 9.7%. This is detached and attached. We're down a little more in new listings for attached properties, but overall down on year-to-date new listings. And then if you look at new listings for August over the last 3 years, you see that, in 2020 we had 2,800. These are detached homes, and then 21 there were less, and now in 22 there's even less. So it's just the number of homes for sale continues to decline despite the perception that there are more homes on the market. There are more homes on the market, but we're coming off of a crisis level low into just low. So that's where we are with new listings. And then if we look at closed sales, that's way off from last year to this year. It's down 30%. Closed sales, so that's that's not great in terms of what it looked like last August and what it looks like this August. Year to date, not off quite as much. So this giant drop in closed sales, as you pointed out earlier, is really a reflection of what happened the prior month or the month before that, even in pending sales.
Closed sales is a lagging indicator.
Absolutely. So moving on to the inventory of homes for sale. Again, 2020 we were up here at 3,100, and again the attached and detached numbers are percentage-wise very reflective of each other. You can tell the shape of these graphs is very similar. So I'm not ignoring attached homes, but in any event, it's very similar. So 3,100 in 2020 August, and then 2,500 last August, and then the inventory of homes for sale jumped up 20% from last August to 3,039 this August.
This graph down here is interesting. The historical inventory, which sure has been since 2020. It took a dip at the end of 2019, and then it's just been
right.
Historically low ever since then.
Yes, and I believe that it's a pandemic thing. I mean, it's a combination of things. A lot of things.
Well, this is in August of 2019.
Yeah. So it started. I mean, this shift in the way that people live, I guess, started happening in 2019, and then the pandemic just solidified and accelerated what was already going on. But yeah, it just the inventory of homes for sale just plummeted in 2019, continued to go down into 2020, and then has been doing this sort of up and down action, sideways action, whatever you want to call it, ever since early 2020. So yeah, the inventory of homes for sale is very, very low, and that's again what's at this point keeping prices somewhat firm. If we had this level of inventory right now, you'd be seeing massive price drops. It's just, but it's not happening. So median sale price, looking at 2020, it was at $739 for detached, and then it went up to $850 in 21. And right now here we are in 2022 at $910,000 for a median price detached home. And so that's up 7.1% from August of last year. So that's really, kind of what you have to track when you're talking about median price. It's you look at it month to month, that's great, but to really track prices, you have to zoom out and look at the bigger picture. And so we are still up 7.1% from last year, and that's a whole lot of money when you're talking about a $910,000 house. And then of course year to date, similarly we're up 13.8%. So prices are still high, folks, and with the squeeze on inventory, it's not likely to really get much better. So if you want to buy, and you should buy, still absolutely you should buy, because buying is hedging against inflation. You could rent, and that's 100% interest. So you can pay 100% interest.
And you can't write it off on your taxes either.
No, you can pay 100% interest in rent, or you can pay, prevailing interest rate. But there are ways to mitigate that, at least for the first couple of years, and then refinance yourself down into a lower rate in a couple of years, because rates are going to go back down. They will. We're going to get a handle on this inflation situation, and rates are going to go back down. And I'm sure there are people that will disagree with me, but the experts agree. So that's what's going on with median sale price.
Well, we've already started talking about rates. Let's go ahead and move on to the rate slide.
Right. Yeah.
I'm going to try not to go on an angry rant about how the consumer price index is calculated. I could do that, but we probably don't have time for that today. So I'm going to try not to, but it might happen anyway.
Well, okay. Save it for the Friday show. All right. So Freddie Mac is telling us that the average 30-year fixed mortgage right now is at 5.89, which is up from last month. And I think, let's see, here we are. Yeah, in the middle of August we were at 5.13. Now we're at 5.89. Pretty ugly. 15-year. I don't know that I've ever helped anybody who bought using a 15-year.
It doesn't happen so much in San Diego with our prices.
No, I've known people who refied into a 15-year, but there's no point in refining into a 5.16 15-year at this point. So the 5-1 ARM is one of these tools that you can use to get your rate down. And there's a 5-1 ARM, there's a 7-1 ARM. Freddie Mac is showing us that 4.64 is the average on the 5-1. And this is a really safe ARM, if you ask me. I mean, ARM gets a bad rap because of what happened, and we remember it for sure.
Oh yeah, we had one of those arms, and it went poorly.
Yeah, we had one. Yeah, we had one of the, we'll call it a broken arm. And nowadays, I mean, the lender makes you qualify on the fully adjusted rate. In other words, they're not going to qualify you on the intro rate. They're going to qualify you on whatever the rate's going to be in 5 years or something similar. So there's not people getting into homes that don't qualify, which is one thing that happened in 2008. And I mean, that's one of the main differences. Also, these are not negatively amortizing ARMs. In other words, your balance isn't going up as you're paying this loan, and those types of loans were rampant in the run up to the 2008 collapse. There were a lot of people that were severely underwater because their loans were negatively amortizing, and that was basically like buying your house on a giant credit card. That's not what this is. This is a tool to lower your rate, keep your rate low for the first 5 years, and you're sort of hedging your bets there and thinking that within 5 years, this rate over here is going to go down, so you're going to refinance out of this ARM within 5 years and get into a 30-year fixed, which is, in my view, an excellent strategy, because again, you're hedging against inflation by locking in a housing payment when rents are rising, 7% a year. And again, rent is 100% interest, folks, and you're not getting any tax benefit. So that's my rant.
And you're paying someone else's mortgage.
Exactly. You're certainly helping out that investor who owned your home. So yeah, that's what's happening this month in real estate. And
well, check us out next time. We'll be back next month with another update.
Yes, like, share, subscribe, and comment.
Thanks for watching. We'll see you next time. If you have any questions about your moving plans, send us a message or give us a call.